What if I told you that two people can invest in the same stock market at the same time with the same amount of money, yet one quietly becomes wealthy, while the other barely beats inflation? No scams, no crypto crashes, no risky day trading, just one decision. A decision most beginners make blindly. Mutual funds, index funds, ETFs, they sound similar. They're sold as safe, they're advertised everywhere. Banks promote them, apps recommend them. But hidden beneath those friendly names is a financial battlefield that has transferred trillions of dollars from ordinary investors to institutions, often without people realizing it. Today, we're uncovering the real story. Where these investment tools came from. Why Wall Street created them. How one simple idea disrupted the entire financial industry. And why choosing the wrong one can quietly cost you hundreds of thousands of dollars over your lifetime. Stay with me, because the biggest twist doesn't come from the stock market. It comes from human behavior. To understand this war between index funds, mutual funds, and ETFs, we need to rewind the clock, back to a time when investing was not for everyone. Before mobile apps, before zero commission trading, before invest with one click. In the early 1900s, investing was mostly reserved for wealthy families and institutions. If you wanted to buy stocks, you needed a broker, paper certificates, and large capital. Then came a revolutionary idea. What if small investors could pool their money together? That idea created the first mutual funds. In 1924, the first modern mutual fund was launched in the United States. The promise was simple: let professionals manage your money better than you ever could. This was powerful. Suddenly, teachers, factory workers, and office employees could invest in hundreds of companies with one purchase. Wall Street had just unlocked a new gold mine, not by outperforming the market, but by managing other people's money. Mutual funds exploded in popularity after World War II. Why? Because retirement systems changed. Pensions slowly declined. Individual retirement accounts like 401ks appeared. Governments shifted responsibility from employers to individuals. No, millions of people had to invest, whether they understood markets or not. Mutual funds stepped in as the solution. They promised professional stock picking, risk management, diversification, higher returns, and investors believed it. By the 1990s, mutual funds controlled trillions of dollars. Fund managers became celebrities. Financial TV shows praised star investors. Newspapers printed top-performing funds every year. But something strange was happening behind the scenes. Despite all this expertise, most mutual funds were failing. Here's the uncomfortable data: Wall Street didn't like advertising. Over long periods, more than 80% of actively managed mutual funds failed to beat the market. Not sometimes. Consistently. Year after year. Why? Because of three invisible enemies. One, fees. Most mutual funds charge management fees, sales loads, and operating expenses. Even a small 1% annual fee can destroy massive wealth over decades. Example: if you invest $100,000 for 30 years, with 8% return you get about $1 million. With 7% return after fees, you lose nearly $250,000. That's not market risk. That's structural loss. 2. Trading costs. Active managers constantly buy and sell stocks. Every trade creates friction, commissions, taxes, and slippage. Those costs quietly eat investor returns. 3. Human psychology. Fund managers are human. They chase trends. They panic during crashes. They follow herd behavior. Ironically, the professionals often behave just like emotional retail investors, but with billions at stake. And this failure created space for a radical idea. An idea that Wall Street initially laughed at. In the 1970s, a quiet man named John Bogle changed finance forever. Bogle believed something radical. You cannot consistently beat the market. So instead, own the market. He proposed creating a fund that simply tracks the entire stock market, instead of trying to outsmart it. No stock picking, no star managers, no constant trading, just passive ownership. In 1975, he launched the first public index fund. Wall Street mocked him. They called it Bogle's folly. Why would anyone invest in something that promises average returns? But something incredible happened. Over time, the average strategy started outperforming most professionals, because it avoided high fees, emotional trading, overconfidence. The math was undeniable, and slowly, painfully, the financial industry realized index investing was a threat to their profit model. Because you can't charge high fees for doing almost nothing. Wall Street needed a countermove. They couldn't kill index investing, so they adapted it. In the 1990s, a new hybrid product appeared, the exchange-traded fund ETF. ETFs combined index-style diversification with stock-like trading flexibility. Unlike mutual funds, ETFs could be bought and sold instantly during market hours. This attracted traders, institutions, and younger investors. By the 2010s, ETFs exploded today. Global ETF market exceeds $10 trillion. Index funds control trillions more. Mutual funds still manage enormous retirement money. 3 tools, 1 investor, but very different outcomes. Then came the moment that exposed everything. 2008, markets collapsed. Banks failed. Retirement accounts were destroyed. What happened? Most active mutual fund managers failed to protect investors. Some even amplified losses by panic selling. Meanwhile, broad index investors who stayed invested recovered faster because markets eventually rebounded. This created a psychological shift. Investors started asking dangerous questions. Why am I paying high fees to lose money? Why not just buy the market? Why trust predictions? Money began flowing out of active mutual funds and into index funds and ETFs. This wasn't slow, it was historic. Over the last decade alone, trillions moved from active funds into passive strategies. Entire fund companies shut down, fee wars began. Wall Street's old business model was cracking. Fast forward to today. The financial landscape has shifted dramatically. Passive investing now dominates global markets. Index funds and ETFs manage more than $20 trillion worldwide. Even traditional Wall Street firms heavily rely on ETFs for client portfolios. But here's the kicker. History is repeating itself in subtle, dangerous ways. The rise of ETFs and index funds mirrors the same patterns we saw with mutual funds decades ago. 1. Mass adoption before comprehension. Millions of investors pour money into ETFs and index funds without fully understanding their structures. 2. Marketing trumps transparency. Many ETFs are sold as safe and diversified, even if they're concentrated in a handful of companies or industries. 3. Hidden systemic risk. Passive investing may unintentionally amplify market crashes. In a downturn, if everyone sells ETFs at once, liquidity problems could worsen losses, unlike owning individual stocks directly. The lesson: just because something is called an index fund or an ETF doesn't automatically make it safe. Let's look at some numbers that might shock you. SPY ETF tracks the S&P 500 in 2022. Over $400 billion changed hands daily. Top 10 ETFs now control nearly 25% of the entire US stock market capitalization. Studies show that in over 90% of ETFs, the largest 10 holdings make up more than 50% of the fund. What does this mean for you? Even diversified ETFs can be heavily weighted toward a few mega-cap stocks, like Apple, Microsoft, Amazon, or Tesla. And if these giants stumble, many ETFs stumble with them, even though investors think they're safe and diversified. Here's another twist many beginners don't see: closet indexing. Some mutual funds claim to be actively managed, charging high fees, but in reality, they almost perfectly track an index. Why is this a problem? You pay 1 to 2% in fees for essentially index-like performance. Over decades, these fees silently erode your returns, sometimes costing hundreds of thousands of dollars. Investors think they're paying for expertise, but they're getting a passive result at an active cost. This is why understanding the structure of your fund is crucial. ETFs are lauded for their liquidity. You can buy or sell shares anytime during market hours. But here's the paradox. ETFs are often derivatives of underlying assets, not the assets themselves. In normal markets, this doesn't matter. But during extreme volatility, ETF prices can deviate significantly from their true net asset value, (MBAF). In 2020, during the COVID-19 crash, some ETFs temporarily traded at discounts of 10% or more, exposing investors to unexpected losses. So, the simple solution of buying an ETF isn't always risk-free. Some analysts warn that passive investing itself could become a systemic risk. As more money flows into index funds and ETFs, prices are determined less by fundamentals and more by fund flows. This could amplify volatility in crises. Large ETFs holding thousands of stocks might artificially inflate prices of weaker companies because the fund must buy them to track the index. In short, the very products that democratized investing could also create distortions in the market. Let's recap the pattern. 1. Mutual funds promise professional management, gives most failed to beat the market, gives high fees and human error cause silent losses. 2. Index funds offered a simple, low-cost alternative, gives disrupted Wall Street, gives eventually became the majority strategy. 3. ETFs combine convenience, liquidity, and diversification, gives attracted trillions, gives now pose new hidden systemic risks. The repeating theme: humans chase convenience and perceive safety. We pay fees or rely on structures without fully understanding them. The same mistakes that cost mutual fund investors decades ago are quietly repeating in ETFs and passive funds today. Takeaways for beginners. After decades of financial evolution, what should beginners absolutely know? 1. Fees matter more than you think. Even a 1% fee difference can erode hundreds of thousands of dollars over a long investing horizon. Always check the expense ratio before buying a fund. 2. Understand what you own. Index funds, ETFs, and mutual funds are not inherently safe. Know whether your fund is actively managed, passively tracking an index, or a closet indexer. Look at the holdings, concentration, and risk profile. 3. Long-term discipline beats short-term hype. Market timing, trends, and fads rarely work. Historically, the simplest strategy, investing consistently in a diversified portfolio and staying invested, outperforms most active approaches. Here's the open-ended question every beginner must consider. If trillions of dollars are flowing into index funds and ETFs, and a handful of mega-cap companies dominate their holdings, what happens if the market faces a severe shock? Are we repeating history just on a larger, faster, more connected scale? The answer isn't clear, but understanding these dynamics today could protect your wealth tomorrow. If you found this story eye-opening, here's what you can do next. Review your investments. Know your fund structures, fees, and holdings. Don't blindly follow trends, question the marketing. Educate yourself on long-term wealth strategies before investing another dollar. And if you want a deeper dive, hit subscribe. In upcoming videos, we'll break down which ETFs and index funds are truly safe for beginners, step by step, so you can invest confidently without falling for hidden traps. Remember, the difference between a lifetime of wealth and a lifetime of frustration, ISNT, in luck. It's in knowledge.